Here's a shocking truth, one that really catches people by surprise. Most investors, they actually lose money. And it's not because the market is rigged or anything like that. It's because we're human. So think about this for a second. We all hear that the stock market, over the long haul, generally goes up, right? So how is it possible that the average person investing in that very same market earns so much less? I mean, sometimes they barely make anything at all, or worse, they lose money. It's this huge puzzle, kind of the biggest mystery in finance, really.
And the answer? It's almost ridiculously simple. The problem is us. Yeah, our own gut feelings, our emotions, our knee-jerk reactions, those are the biggest obstacles standing between us and our financial goals.
Okay, so here's how we're going to crack this case. First, we're going to pull back the curtain on what's called the great performance gap. Then we'll take a look inside our own brains to see what's really driving our decisions. After that, we'll run through the 8 deadly sins of investing. We'll even see why the pros mess this up too. And stick around, because at the end, I'm going to show you exactly how to close that gap for yourself, for good.
All right, first up, let's head to the scene of the crime. I call it the case of the missing returns.
Okay, look at this. On one side, you've got the market's return. This is what the investment itself, say a simple index fund, actually generated. Pretty good, right? A nice solid number. But then, look at the other side. That's what the average person who owned that exact same fund actually walked away with. That gap between the two, it's huge. And that, right there, is where so much money just vanishes. There's actually a name for this. It's called the behavior gap. A financial planner named Carl Richards came up with it, and it's just so perfect, right? It's the gap between what the investment does and what the investor actually gets. So the crucial point here is that the fund didn't fail. Our behavior failed. It's our choices about when to get in and when to get out that create this massive problem. And check this out. This is fascinating. Data from Morningstar shows that this gap isn't always the same size. When people chase those really exciting, high-flying funds, the trendy ones, the gap is massive. We're talking 2.6%. But look what happens when they invest in boring, old, diversified funds. The gap shrinks to almost nothing. What does it tell you? It's crystal clear. The more we let our emotions and our need for excitement drive our decisions, the worse we do. So, this brings us to the big question. Why? If our behavior is the problem, then we have to look at the thing in charge of our behavior. Our brain. Yep, turns out the call is coming from inside the house. The culprit is you. It's me. It's us. Now here's the really tricky part. The thing that messes everyone up. When you're in the moment, making a decision based on pure emotion, it doesn't feel emotional. Not at all. It feels totally rational. Selling everything when the market is crashing, that doesn't feel like panic. It feels like being smart and protective. Buying that hot tech stock everyone's talking about, that feels like a brilliant opportunity. Our emotions are masters of disguise, pretending to be logic. And that's what makes them so incredibly dangerous. Okay, let's meet the first villain in our story, overconfidence. This is that little voice in your head that says, hey, you're smarter than everyone else. You can totally pick the next big thing. You can see the crash coming. And what happens when we listen to that voice? Well, we start trading way too much, letting fees eat away at our returns, and we end up taking these wild risks that we don't even fully understand. All right, villain number 2, herd behavior. Look, we're social creatures. It's baked into our DNA to feel safe when we're in a crowd. So when everyone around us is buying, it feels crazy not to join in. And when they're all panicking and selling, it feels like the only sane thing to do is sell too. The problem is, in the world of investing, the herd is usually a stampede of lemmings heading straight for the nearest cliff. And now for the big boss, the one that causes the most damage, loss aversion. This is a really powerful one. Scientists have actually shown that losing, say, $100 hurts us psychologically more than twice as much as the pleasure we get from gaining $100. We are terrified of losing, and that intense, gut-wrenching fear is the fuel for the single biggest mistake that almost every investor makes.
So we've met the psychological villains, but how do they actually show up and mess up our portfolios? Well, let's walk through what I call the 8 deadly sins of investing.
And here it is. The absolute number 1 sin, laid out perfectly. It's the cycle of failure, and it goes like this. The market gets hot, everyone's making money, greed and FOMO, the fear of missing out, take over. So what do? We jump in and buy right near the top. Then what happens? The market does what it does. It drops, and that greed turns instantly to fear and panic. So we sell right at the bottom. We just bought high and sold low. This one destructive loop has wiped out more wealth than probably any other mistake in history. And really, all the other mistakes are just spin-offs of the same core problem. Trading too much because we think we're geniuses, trying to time the market perfectly, chasing last year's hot stock, getting totally overwhelmed by the 24/7 news cycle. All of it, every single one, is just a symptom of the same disease, letting our caveman brain make our 21st century financial decisions. Now, at this point, you might be thinking, okay, I get it for us regular folks, but what about the professionals, the people in suits who do this for a living? Why do so many of them fail to beat the market too? It's a great question. Well, a big part of the answer has to do with this really sneaky statistical trick called survivor bias. The easiest way to think of it is like this. The funds that do really badly, they just disappear. They get quietly shut down or merged into other funds, and their terrible track records get erased from history. So when you look at the data, you're only seeing the performance of the survivors, which makes the whole group look a lot smarter than it actually is. I love this quote from ETF.com. It says, survivor bias is like grade inflation for mutual funds. It's perfect, right? It's like a teacher just throwing out all the Fs before calculating the class GPA. The average looks amazing, sure, but it's not telling you the whole story, not even close. So does this little statistical trick really matter? Oh yeah, it matters a lot. Studies have shown that if you factor back in all those dead funds, the real average return for active managers drops by about 1.6% a year. Now, that might not sound like a huge number, but over decades, 1.6% is the difference between a comfortable retirement and, well, not. Okay, enough about the problem. That's the bad news. The good news is that we can absolutely fix this. So let's talk about the solution. How do we close our own personal behavior gap? The solution is actually pretty simple, but it's not easy. It's this. Success in investing has very little to do with being a genius who can predict the future. It's not about market mastery. It's about self-mastery. It's about controlling that person in the mirror. So here's the game plan, the right way to do it. And listen, most people get this 100% backward. They start at the end, chasing some hot stock or fund they heard about. No, you have to start at the beginning. Step 1, what are your values? What actually matters to you in life? Step 2, turn those values into real specific goals. Step 3, build a simple written plan to reach those goals. And only then, as the very last step, do you pick the investments to power that plan. Values, goals, plan, then products, not the other way around. And once that plan is in place, you know what the hardest part is? Doing nothing. Seriously, Warren Buffett has this amazing quote where he says his secret is benign neglect bordering on sloth. He's basically saying the less you mess with it, the better. Investing is one of the few areas in life where being a little bit lazy can actually make you rich. So in the end, it really all boils down to one thing. The biggest threat to your financial future isn't a recession or a market crash or some scary headline. It's the person you see in the mirror every morning. So the question is, will you create a plan and master your behavior, or will you let your emotions make you just another statistic in the behavior gap? The choice is yours.